Hello, I'm Jim Lebenthal, Chief Market Strategist at Cerity Partners. I'm here with Dr. Amita Schultes, a partner in our outsourced CIO business focused on investment advisory work for endowments and foundations. Amita and I are going to go through our market and economic outlook for the third quarter of 2026. Thank you for joining us today. Without further ado, I'm going to turn it over to Amita, who will start us off, and then I will add my comments after hers. Amita, let me bring up our thoughts for today, and once I do, why don't you take it away?
Thanks so much, Jim. I'm going to kick us off by walking through what's been happening in the markets and the economy, and more importantly, our views on those items going forward. But I thought I'd give you a brief headline for today. The backdrop for markets is still supportive, but it's a different kind of supportive, I would say, than it was a year ago. I would think less policy doing the heavy lifting and more private investment carrying the load. And I'll unpack what that means as we go through. But first, let's take a look at the market environment we've seen in the first half of the year. The last 2 quarters handed us a near perfect lesson in why discipline beats prediction. And you can see why that's the case on this slide. And what you're looking at is a simple returns table here, 2 quarters side by side, and they look almost like mirror images of each other. And here's the single most striking fact on the entire slide. I think the first quarter leaderboard flipped almost perfectly upside down in the second quarter. What worked spectacularly in the first quarter is exactly what lagged in the second. Start with crude oil, for example. In the first quarter, crude was a standout winner, up 80%. In the second quarter, it was the worst performer on the board, down 32%. Same asset, complete reversal. If you think about why, the first quarter was a geopolitical shock quarter. The onset of the US-Iran conflict in late February sent energy and commodities soaring. Crude went up 80%, commodities were up 24%, gold was up 6% as investors reached for a safe haven. At the same time, risk assets sold off, and you can see it. US large cap was down 4%, global equities were down 3%, even a balanced 60-40 portfolio slipped about 2%. And it's a textbook risk-off quarter. Real assets and the dollar up, equities down. Now, if you look at the second quarter, as the geopolitical risk premium came back out of energy, crude gave back 32% and gold fell 13%. Equities, you can see, delivered one of their best quarters in years, and you can see it across the board. Emerging markets were up 24%. Much of that was powered by the AI and semiconductor theme, but U.S. small and mid caps were also up significantly, up 20%. U.S. large cap and global equities were both up 15%, and international developed was up 11%. And notice the rebound was really broad. It was global. It was not just a U.S. large cap story. I think the lesson embedded in these two columns is fairly straightforward. An investor who chases performance would have reacted to that great first quarter by piling into oil and commodities. They would have walked straight into the worst losses of the second quarter. They would have also gotten scared out of equities after being down 4% in the first quarter. And they would have missed a 15% recovery in the second quarter. Now, that's the clearest possible argument I can make against chasing performance and trying to time the market. If you look at that 60-40 line specifically, down 2% in the first quarter and up 9% in the second, it gives you a sense that staying diversified and staying invested through what was a really uncomfortable start is exactly what captured the rebound. And worth noting, in the second quarter, both international and emerging market equity actually beat U.S. large cap. Just goes to show that global diversification isn't dead, and in fact, sometimes it leads. Last thing, meanwhile, cash and intermediate treasuries were quiet in both quarters, as you can see, hovering around 0 to 1%. That's exactly the ballast role they're supposed to play, pretty much boring on purpose. So the takeaway, rather than trying to guess the rotation or chase performance, it often pays off to simply stay the course. Let rebalancing discipline do the work, trim the winners, add to the laggards. It's what's important, as we like to say, time in the market, not timing the market. And these two charts side by side are almost a literal illustration of that concept. Let's zoom out now, though, and take a little bit of a bigger picture view on the next slide, where we start to talk about new risks, new uncertainties, but still on balance, a supportive backdrop. Here's how we're thinking about the year in 10 key themes. And I'm going to walk you through each of the 10 of these. So theme 1, The policy is finally balanced with AI as the constant. And here's where policy actually sits today. If you look at the Fed funds target, for example, the range is in the 3.5 to 3.75% with an effective rate around 363. The Federal Open Markets Committee has held steady at every meeting this year after cutting 3 times in the final months of 2025. So monetary policy is now parked near neutral, no longer a headwind, no longer a tailwind. And underneath it all, the AI CapEx super cycle just keeps on running independent of the rate cycle. One nuance worth flagging, if AI and productivity have lifted the neutral rate, then neutral is a higher number than it used to be, which means today's policy may actually be less restrictive than the 3.6% headline suggests. So the takeaway here, a healthier, more durable growth mix, less sugar high, more protein packed, if you will. Our second theme is that new tax law is broadening the CapEx story beyond AI, and the mechanism by which this is happening is important. We've seen restored 100% bonus depreciation, immediate expensing of domestic R&D, more generous interest deductibility. All of that lowers the after-tax cost of capital and pulls investment forward, and it widens the story from just the hyperscalers and data centers into traditional things like manufacturing, equipment, and industrials. The CapEx story is no longer a story about 7 companies, and broader CapEx is what eventually feeds broader earnings, which is something you're going to hear much more about from Jim a little bit later. Our third theme is that we do have a US-led global expansion. The economy is expanding at a solid pace despite elevated uncertainty. Much of that uncertainty is tied to the conflict in the Middle East. We view the rise in energy costs as a supply shock, a one-time level effect, if you will, and not a persistent trend. And for now, US growth leadership is in fact carrying the load. Fourth theme related to the US is a tight labor market, but for a bit of an unusual reason. In June, unemployment fell to 4.2%, but for the wrong reason, really. The labor force participation rate dropped 0.3 of a point to 61.5%. That's the lowest since March of 2021. And the labor force itself shrank by 720,000 people. Meanwhile, hiring cooled but stayed positive. And the point here is that we have very modest hiring plus a shrinking labor supply, which is keeping the labor market tight. If you strip out the pandemic, participation is the lowest that we've seen since 1976. Fifth theme is that the last mile of inflation is somewhat like the last 5 minutes of a World Cup soccer game. It's long and it's hard fought. Headline CPI fell to 3.5% in June. It's the first decline that we've seen in 5 months, down from 4.2 in May, and it was really driven by a reversal in energy. But critically, core inflation eased to 2.6%, with the monthly core reading flat. So the underlying trend is closer to target than the headline lets on. There is a risk to flag here, however, and that's the disruption near the Strait of Hormuz continues, of course. So there is a renewed energy shock that is a real threat. But the takeaway really is to not overreact to a hot print if the driver is supply. The real danger is if supply shocks get unanchored from inflation expectations. And I'm going to talk much more about that later. Theme 6 is that there is now genuine uncertainty at the Fed and with Warsh. With new leadership at the Fed, the open questions are really threefold: rates, the balance sheet, and how the new chair reads AI as an inflationary demand for power and chips, or as a productivity enhancing and disinflationary. A leadership transition means elevated policy uncertainty, and we expect a distinct shift in communication style. And that too, I will talk much more about later. The seventh theme is that we're not counting on a big rally in long rates. The 10-year is now at 455 and the 2-year at 418. That's a modestly positive curve, not the deep inversion that we saw a couple of years ago. The long end answers to growth, treasury supply, and term premium, and all three argue a meaningful decline. Even if the Fed eventually cuts the front end, the long end may simply not follow. Eighth theme is that fundamentals are doing the work, not multiples. The forward 12-month PE is at 20.3 times, above the 5-year average and the 10-year average, which are at 19.9 and 19 times respectively. So elevated, but not a bubble multiple in our view. And here's the offset, which is earnings. Consensus has 2026 earnings growth at 24.5%, 2027 at 17.5%. And when earnings compound like that, you don't need multiple expansion to make money, earnings really grow into the multiple. The flip side, high multiple levels leave less room for error, so misses get punished. And for that reason, while we expect earnings driven returns, we also expect more volatility around disappointments. Ninth theme, broadening of the equity market was postponed in our view and not repealed. The top 10 stocks now make up nearly 40% of the S&P, so index earnings have leaned heavily on a handful of mega caps, but the ingredients for broadening are falling into place. CapEx, rate stability, and AI benefits are diffusing into non-tech sectors, slower than anticipated, but not canceled. The thesis, in our view, is still intact. It's just taking more time. And the 10th theme, that international equity is at a discount, not a write-off. The valuation gap is really significant here. If you look at developed international, it's trading at around 16 times forward earnings versus 20 times for the S&P 500, so a 20% discount and one of the widest gaps that we've seen in decades. And we saw international outpace the US in the second quarter, as I showed you earlier. So the catch-up may already be underway. But we would suggest that you should not abandon international just because the US outperformance has been more consistent in recent years. Geographic diversification, in our view, is generally wise to have within equities. Now let's get closer to the economic data, starting on the next slide, which is inflation related. And the big picture with the data I'm going to share with you over the next few slides is really this. We see a private investment-led broadening expansion, not a policy-driven one. So remember, more protein-packed and less sugar high. Inflation is coming down, consumers are spending, and the labor market is tight. The one real strain is affordability, especially in housing. But we're going to get to each of those things. Let's take a closer look at inflation first. June CPI report was surprisingly favorable. Prices actually fell 0.4% versus May, and the annual rate, as I mentioned, dropped from a recent high of 4.2% down to 3.5. If you look at core, which strips out food and energy, that was flat on the month and 2.6% year over year. That's a welcome relief after a sharp monthly spike we saw in March, April, and in May when the Iran conflict sent oil, gas, and really anything connected to them soaring. But truth be told, even at a 3.5% rate, that is still high by recent standards. And here's the detail that matters for all of us, that 3.5% is also roughly the pace at which average hourly earnings grew in June, which means workers, who are also consumers, are barely getting ahead. If you think about this in real earnings terms, meaning wages after inflation, they actually turned negative in April and May, and in June just about broke even. So that's a different world from the post-pandemic period when wage gains outpaced inflation. In fact, over the last 19 months, wage growth has gradually slowed from 4.2% to 3.5%. And employees at smaller businesses are actually seeing even less growth than that. But yet, here's the thing, which we can look at on the next slide. Consumers keep spending. When you look at retail sales for necessities like gas, people have simply rolled with higher prices. They don't really have a choice here. But we've also seen strength in some funner things like sporting goods, craft supplies, books, musical instruments, even hobby spending was up. Hobby spending was up 11.3% year over year. And that somewhat echoes what we saw during the COVID crisis. You'll recall things like sourdough and puzzles and Peloton. But importantly, now discretionary spending, especially among lower and middle income households, has increasingly shifted onto credit cards. And we've watched this pattern for the better part of 40 years now. When gas prices spike, Americans don't cancel their vacations, they just put it on the card. And what they do is skip their savings contribution. And the savings rate in this way tends to be a shock absorber for Americans, not the spending. And we have seen that in the savings rate so far this year. Worth noting, not everyone has had to adjust. We've talked a lot about the K-shaped economy, and there's been no dramatic pullback among upper income households. You see it in travel, for example. Premium airline routes are still fully booked. There's a structural point here to keep in mind that the top 20% of American earners drive somewhere between 36 and 50% of all consumer spending. So our economy is increasingly dependent on that top slice of consumers. And the lower income earners are the ones that are changing their behavior, and they have really been changing their behavior. I'll give you a real world example of this. PepsiCo, which is, of course, the maker of Doritos and Gatorade and Pepsi, reported net revenue up more than 6% year over year. But there was one soft spot. That was North America. U.S. food and beverage sales were weak in the spring, especially at convenience stores and gas stations. So think about that. Gas prices are so salient. We're all standing next to the car, staring at that digital display. Some people just decided not to grab that soda and the bag of chips from inside. That could be short lived, however. We've seen this in the past. After a shock, people usually pull back pretty hard and then quietly drift back to their regular soda drinking and chip eating ways. But it does give some indication of how people are feeling in the near term and what sentiment is. So let's take a look at sentiment on the next slide. And here you see consumer sentiment is fairly low. Small business optimism is generally waning as well. Job openings, hiring plans are at the lowest level that we've seen in 6 years. Businesses are citing things like fuel costs and taxes and labor costs as their top challenges, along with inflation, of course, which is cited not only as a concern by businesses, but also by consumers. People's expectations, however, are changing as well. And I would posit that people's expectations about inflation is what really matters, because inflation expectations can very much be self-fulfilling. If consumers and businesses come to expect higher inflation, workers ask for higher wages, firms preemptively raise prices, and it becomes embedded. There is some encouraging news here. Recent surveys from both the New York Fed and the University of Michigan show that long-term inflation expectations are holding steady or even easing. So expectations remain anchored as it relates to inflation, and that's what keeps the Fed's options open when it comes to rates. And we are going to talk about rates, but before we get there, let's look a little bit more closely at the labor market on the next slide. And I have to say, the labor market is at a pretty odd place right now. The numbers look good, while the job market for many just feels bad. The unemployment rate is at historically comfortable 4.2%, but wage growth has been suppressed for a while and job churn has dried up. If you look at the quits rate, that's hovered at around 1.9%, which is near the lowest in over a decade. And the raise that people get for switching jobs, it's only down to about 5% in the first half of this year versus over 10% back in 2022. So the question is really, why is there so little quitting amongst workers at this point? And we can only point to one thing, which is that people feel very uncertain. The risk of switching just feels too great. It seems like there's career gridlock. We're in this low hire, low fire economy. Companies are hoarding the workers they have, but not adding new ones. It's a bit of musical chairs where everyone kind of stays seated. The job boards are full, LinkedIn is full, but nobody's actually moving as it relates to jobs. And that brings us to the sharpest affordability pressure that we're seeing right now, which is housing. And that's on the next slide. And the near-term data is actually calm. When you look at rents, they're pretty tame. Existing home sales rose 3.2% in May. The median sales price is just 1.3% year over year. Mortgage rates are a touch lower than a year ago. So both home prices and shelter costs are sitting on a high plateau, elevated in level, but flat to slightly down in terms of growth. And the strain that's coming from that level is that it's locked in high, and mortgage rates are hovering near 6.3%. But here's a number that should really get your attention. Harvard's Joint Center for Housing Studies tracks household formation. In 2021, about 2 million new households were formed. In 2025, only 1 million new households were formed. Why? That's because housing costs have run far ahead of wages. The 26-year-old who a few years ago would have rented their own apartment is now splitting a 2-bedroom with roommates. That's a latent demand bond. When conditions normalize, those people don't disappear. They form households all at once, and there currently are not enough homes to go around, and that could ultimately push home prices even higher from where they are today. And affordability leads us right to the Fed. So let's look at that on the next slide. And the story here has completely shifted. Fed funds futures went from pricing in a few rate cuts to pricing in a few rate hikes. And as it stands, the market is predicting a 22% chance of no change in rates and a 70% chance of 1 or 2 hikes and a 7% chance of 3 hikes. Rate cuts at this point are essentially completely off the table. I think it's important to have a bit of historical context here in that the Fed has raised rates just once back in 1997 without launching a full hiking campaign. So a single hike would be very unusual. And that's part of why this moment carries so much uncertainty. Adding to this uncertainty is that there's a new sheriff in town, Kevin Warsh, and he has set a decidedly different tone at the Fed in 3 key ways. First, in testimony to the House Financial Services Committee, he framed the stakes very bluntly. 63 months of inflation above target, he said, has been an unfair burden, a tax on the American people and on businesses, and the Fed plans on getting rid of that tax. In his press conference after the last OFMC meeting, he repeated a striking phrase: inflation is a choice. And that may have been a deliberate Volcker callback, a signal that Warsh is willing to be unpopular to get the job done. The second way Warsh is setting a different tone at the Fed is that he's indicated there may be less communication going forward. Now, Warsh has stated he's very skeptical of forward guidance. He has hinted at possibly ending the post-meeting press conferences altogether, and the dot plot itself could be discontinued. The dot plot, remember, is where the Fed governors share what they expect rates will be in the future. This go around, Warsh didn't even submit a dot for the dot plot. Now, he's not being cagey. It's not that he just has forgotten to give a forecast. He just has a rationale for less communication, which is he thinks markets work less efficiently when they're just guessing how the Fed will react to data. Market prices, in his view, are supposed to be a source of information, not an echo of what the Fed has already told them. So he's in favor of less communication. And the third change he's made at the Fed is that he's instituted 5 new task forces, laying the groundwork for some real institutional change, I would say. Those 5 task forces focus on Fed communications, balance sheet policy, data sources, productivity and jobs, and the inflation framework itself, meaning how inflation is measured, not the actual target. So where that leaves us with the Fed is ultimately the Fed's ability to hold rates where they are depends on long-run inflation expectations staying anchored. Oil is the critical swing factor here, and renewed US-Iran tensions create fresh uncertainty there. But for now, we read higher oil prices as a shock that will pass, and we do not expect the Fed to hike at the upcoming meeting. Later in the year could be a different story, however. Let's look at the bond markets, and the bond market has moved in the same direction. You can see more hawkish. The base case for the bond market has shifted to at least 1 hike by year end. You can see it in the curve. The 2-year has trended up since March, sitting around 4.14 to 4.19%. The 10-year has been steadier in the 4.5 to 4.6 range. And it's not just the US. You can see on the next slide, central bankers around the world have turned to a more hawkish stance. The European Central Bank raised its key rate a 1/4 point to 2.25, citing inflationary pressures from the Middle East conflict. The Bank of Japan lifted its rate a 1/4 point to a still low 1%, flagging the drag from higher oil. And the Bank of England held steady at 3.75, pointing to falling energy prices as well, while still worrying about second round effects on wages. So let me bring it all back together before I pass it to Jim. On the economic front, we have inflation cooling, unevenly, but cooling, a consumer that keeps spending, leaning increasingly on the top earners, a labor market that's tight and quiet at the same time, a Fed under new leadership with a clear singular focus on price stability and a more hawkish tone, and underneath it all, a broadening private investment-led expansion with the AI CapEx cycle as the structural constant. So more protein-packed, as I mentioned, and less sugar high for the economy. And it's a supportive backdrop, but one with real live risks. Energy, geopolitics, affordability all come to mind. But if we go back to where we started, those 2 mirror image quarters, investors who came out ahead weren't the ones who predicted the rotation. They were the ones who stayed diversified and stayed invested and let discipline do the work. And there is no more disciplined an investor or strategist than our very own Jim Lebenthal. So I'm going to stop here and pass it to Jim to share his insights and views on the market landscape.
Okay, thank you, Amita. I'm going to take what Amita said and apply it to the markets. Looking first at what has gone on so far year to date, that will inform us, I think, as far as what the second half of the year may bring. As Amita mentioned a few times, there has been a broadening in the rally. We can see this on the left-hand side, in which the S&P 493, which is to say the S&P 500 x the Mag 7 stocks, have outperformed overall the S&P 500. And the S&P 500 equal weight index, which is a measure of the average stock in the stock market, has outperformed the market cap weighted index year to date. So this is curing a situation that we've spoken about for quite some time, and which Amita alluded to, in which the top 10 stocks in the S&P 500 currently comprise about 40% of the weight. And there's been this concern that how would that equalize from this historically very high level? Would it require the market to come down overall? Or, as has actually been the case, would the rest of the market catch up? I'm glad to say the rest of the market has caught up, and it hasn't required the overall market to come down. But the real story of the second quarter and the year to date is shown on the right-hand side, which is Micron, what used to be a fairly sleepy, commoditized memory chip manufacturer, which has pivoted to being a critical supplier to the data center build-out that's going on for the artificial intelligence industry. And as you can see from the chart on the right, it has had one heck of a year, up 240% on the year to date, even though it's off about 30% from its recent high. Originally, I wanted to put the chart of Micron over the chart on the left, but as you can see from the Mag 7, it absolutely obliterates any variation in those other indexes. It's just the story of the quarter, and it will be the story going forward. Now, I'm going to address some of the risks inherent in Micron and the memory chips a little bit later on in my talk today. But before I do that, I want to revisit a little bit more of what we talked about last time, because there were some bugbears last time, certainly through the first quarter and into the second quarter. This concern about software being completely disenfranchised by artificial intelligence has taken on a much more muted tone in terms of what its risk really may be. Now, as you look at this chart of the software sector, you may say, well, that's not much of a recovery from the decline in the fourth quarter of last year and first quarter of this year. That's true, but there is a bottoming that has gone on here. And there is a recognition in the market that the fears of software's demise were certainly exaggerated. And you're starting to see some indications of people realizing there may be bargains here in the software space. We're not sitting here recommending that you go rush out and buy all the software stocks. We're simply pointing out that quite often when the media grabs hold of a story, it overplays it. And the design there is to make you feel afraid of something that is likely less important than maybe the media would have you believe. And that is true in another of the last quarter's main risk, which was private credit. Now, to be fair, there are still plenty of headlines about investors exiting private credit and gates on the underlying funds being put up such that those redeeming investors can't take all their money out at once. But there's a few things to note here. First, on the left-hand side, well, actually both charts are showing that the overall default rates in private credit are really quite low. And if you look at many of the private BDC companies, you will see that they've actually had decent years so far, up about 3% in the first half of the year. That's a little bit below their historical rates, but still, that's positive. This is not an asset class that is going through a demise right now. And as much as retail investors have been heading for the exits, institutional investors have been coming into the space. So there are gross inflows into the private credit funds. Lastly, on this note, the headlines sound terrible when we talk about private credit funds putting up gates. But as we said last time, and as we will continue to say, those gates in which the funds limit redemptions to 5% of the overall value in a quarter are a feature of the space. They are designed to match liquidity for redeeming investors with liquidity that comes from the underlying loans themselves, most of which have an average maturity of around 4 years. So it's really matching liability and liquidity as opposed to some nefarious action going on by the managers. In short, private credit was definitely a bugbear in the first quarter. We thought at the time, and we think now, that that is very much overhyped. Similarly, another risk, and Amita talked about this, that we've been talking about not just this year, but certainly in 2025, is the concept that America might be losing its dominance in the financial markets and in the trade-oriented economy. We certainly understand why this fear has been out there, starting with the Liberation Day announcement of tariffs about 15 months ago, and then certainly over the course of this year with a lot of geopolitical activity in Venezuela and in the Persian Gulf versus Iran. Our allies have certainly felt stressed by our actions, and there has been a reasonable question about where America's place in the global order would be. A look at the US dollar index shows that there is stability. And frankly, it's not far from the range that we've been in for the last 5 years, a range which, by the way, is a little bit higher than a longer-term multi-decade chart of the dollar would indicate. In short, there is no run on the dollar. And as much as 10-year Treasury yields have gone up, Amita pointed that out, they're not in nosebleed territory. In short, the fears of selling America and America losing its dominance in both the economy and the markets has been overplayed. Now, there are risks facing the markets, and I want to get to those. Before I do so, I want to point out the biggest fundamental support for the equity markets in particular. And it is the very strong earnings growth that is projected for the coming quarters, well over 20%. Although we only projected this through the end of the year, similar growth rates are expected in 2027. And for a market that is currently trading at roughly 18 times forward earnings, to have 20% year-over-year earnings growth would indicate that this market is fairly valued, maybe even a touch cheap. Again, that multiple of 18 times referenced against 20% plus earnings growth indicates, at the very least, this is not an expensive market. But there are some risks that we should talk about. The artificial intelligence infrastructure build-out continues to be very large. It shows no sign of stopping. And we're talking, of course, about the data centers that are being built not only in the US, but around the globe. The cost for which has been very high, and it has necessitated the use not only of free cash flow from major technology companies like Amazon, Microsoft, Alphabet, but also issuance of equity and debt. This has been a concern for the markets, and the good news on this is that we are just now at the beginning of the second quarter earnings season. And so we will get imminently earnings reports from those hyperscaler companies that I mentioned, as well as others, and they should give us some keen insight into whether the artificial intelligence build-out is a real economic boon or, as some people fear, a bubble. Some of the things that will be looked at are, number one, is the pace of capital expenditure going to continue? Every indication so far from what these companies have said is that, yes, this artificial intelligence capital expenditure will continue. It is profitable for them, and they have more demand than they can meet with supply. So it's highly likely that their capital expenditure plans will continue. Then, of course, the question will be, what are the costs? And I mentioned Micron earlier. Micron has been able to raise prices, as have many chip manufacturers, because of this insatiable demand. So costs are going up. And there are political winds blowing against data center build out. So these are things that we will be paying attention to on the upcoming earnings calls. But the last thing is probably the most important. We will be listening to hear if these companies continue to say that they are supply constrained. If they continue to say that every increment of computing power that they bring online is not only accounted for by demand, but profitable. We suspect, by the way, that the answers to all of these questions will indicate that the artificial intelligence build out is real. And is not a bubble, although there are always risks. And I should point out that over the last couple of weeks, there have been concerns that Chinese large language models are much cheaper to build and have comparable capabilities to U.S. large language models. That is something we are going to pay attention to. At the moment, we don't think it is a big enough effect to interrupt the artificial intelligence build out. But again, these earnings reports coming up over the coming weeks are very important. And there is some newer risks to monitor. Now, I want to come back to where I started with the talk about Micron, because there has been a great deal of volatility, not just amongst Micron shareholders, but amongst all of the chip manufacturers. And we think this has a lot to do with market dynamics and new investors that have come to fore over the past few years. What I'm showing here in this chart is how rapidly levered ETFs have picked up. These are exchange traded funds that basically offer investors amplified returns either on a sector like semiconductors or even individual stocks like Micron. There has been $200 billion of these exchange traded funds that have been issued. And on average, they have a 2.5 times multiple on the underlying sectors or stocks that they are tied to, which indicates that $500 billion is tied up in these particular exchange traded funds. As I said, they magnify returns. Those returns are good on the way up, but they get magnified on the way down as well. And we've seen that recently. In the last 2 weeks, we've seen a dramatic, almost 35% fall off in the Korean stock index. Now, you may be wondering, why am I referring to the South Korean stock market? Isn't that a little bit arcane? No, it's actually front and center for the semiconductor companies and the artificial intelligence build out. Because as you can see from the box on the right, over half of the Korean stock index, the KOSPI, is comprised of just two stocks, SK Hynix and Samsung Electronics, both of which are memory chip manufacturers. So the Korean Stock Exchange is really a referendum on the chip building industry for the data centers that are powering the artificial intelligence trade. And it's come off about 35% in the last 2 weeks. And what it's really indicating, I'm showing on this slide in the lower right-hand side, you'll see a headline there from Bloomberg, and I want to put some numbers to this. As of last Monday, there were 1.2 million accounts in Korea that received margin calls. Margin calls are when a stock decline gets magnified either by margin debt, which has been increasing through time. As you can see in the chart, that's for U.S. margin debt, or it gets amplified by the exchange traded funds, those levered exchange traded funds, which magnify the loss as well as the return. And when that happens and a client's equity goes below a minimum level, then the brokerage firms that have extended that margin debt basically call in the loans. And as the adage goes, when the market clerk calls you up, he doesn't ask if you want to work the order. He just sells the stock and he asks no questions. Of those 1.2 million accounts that got margin called, 350,000 of them were completely liquidated. And that certainly has played a role in the decline of the KOSPI, and it has played a role in the decline, recent decline of Micron and some of the semiconductor stocks. But it's important to note that this is a temporary phenomenon. And if I look at the chart of margin debt in the US, this is going back 75 years, a good long time. It's important to note that we haven't grown above trend. This is a logarithmic chart, so it is showing that the rate of growth is consistent. It does also show that when you have little peaks in margin debt outstanding, like we have right now, that quite often there is a small consolidation phase, that may well be going on right now, and it's being writ large in the semiconductor space. But to put it bluntly, this is a transient, temporary effect. This is not something that is fundamental. Those earnings that I talked about are really where the fundamentals lie. Okay. So, you, our viewers, have submitted some questions prior to Amita and I joining you today. And we've curated some of the bigger ones that we want to go into in a little more depth. Hopefully, we did touch on these in our prepared remarks, but let's go a little bit further right now. And Amita, I'm going to turn to you. The geopolitical situation is hot across the globe. You and I have both spoken a little bit about what's going on with the war in the Persian Gulf versus Iran. We have the ongoing conflict between Ukraine and Russia, and lingering out there are fears that China might forcibly reunify Taiwan. Can you address how we should be looking at these geopolitical risks as investors?
Absolutely, Jim. I'm happy to. And I think all of those that you mentioned are important. The Middle East and the Strait of Hormuz are probably the most relevant and important in the near term, and that it has created much uncertainty. And I mentioned earlier that central bankers around the world have raised rates due to related concerns. The ECB, for example, cited inflationary pressure from the Middle East conflict. The Bank of Japan flagged the drag from higher oil. In terms of where the price of oil is going to go, if you look at the forward curve for oil, it's sending very much a split message. The long end points lower, but the front end has snapped back on the renewed US Iran conflict of late. And the curve ultimately, however, still implies a well supplied, lower priced world over the next 1 to 5 years. But the gap between the back end and the front end really shows the geopolitical risk and tension. I think it's worth noting that other commodities won't move as quickly as oil may once the tension settles down. Natural gas and aluminum, for example, have seen a significant amount of degradation of infrastructure. Unlike oil tankers that can reroute, natural gas pipelines and LNG terminals are fixed infrastructure. If a pipeline goes cold, it can literally corrode. And so the restart isn't as easy as it is for oil because there is a lot of physicality related to that. But there is some movement in other ways in oil. Chevron, for example, is exploring a deal with the Iraqi government to transport crude oil out of the country without having to pass through the Strait of Hormuz. Any alternative shipping route, of course, is going to involve new oil pipelines, potentially from Iraq through Syria and to the Mediterranean. Right now, we don't have a lot of details on this deal. It's been very vague. I think of it as a little bit of a pre-deal of sorts, a commitment to start exploring an actual deal, but it would involve multiple governments operating in what is a very politically unstable region. And of course, deciding who's going to pick up the tab. So while there's interest in doing this, I do not anticipate it will be quick, but ultimately expect more volatility and uncertainty until we get some relief from these tensions in the Middle East.
I thank you, Amita. I will address the next question, which has taken many forms from many of you, our viewers. And it basically comes down to, are we on the precipice of a market crash? And the strong answer to that is we just don't see that happening anytime soon. Now, obviously, we're predicting the future. We could, of course, be wrong. That's inherent to predictions of the future. But much of what Amita and I have spoken about has been very supportive of the markets. A growing economy, stable labor markets. And Amita pointed out there's questions about the labor markets. People don't feel good about the labor markets, but there are clear indications that the labor market is growing. More than anything else, profit growth, as I pointed out, is supporting the equity markets. When you put all these powerful forces together, it's very hard to see a near-term recession or bear market. There are, of course, risks. At the top of the list are inflation and the possibility that the Fed starts a rate hike campaign. The jury's still out on that. The Fed is going to collect more data before they make a decision to raise rates, and we don't know how that data is going to come in. However, those powerful forces that I mentioned would indicate that there is no imminent recession or bear market about to happen. What can happen is a consolidation at any point in time, a correction. They routinely happen, usually once a year. But those corrections, while they can be fearful when they happen, are not indicative of a market crash. They're something that we should buckle our seatbelts as investors and get through. And for our final question, I just want to talk a little bit more about the AI bubble, or the potential that it's a bubble, because it's a question that comes up quite often. I've addressed this a little bit with regards to the risks of Chinese large language models, political risks, the blowback against data center buildouts. These are real risks. However, when we think of what a bubble looks like, we go back to the late 1990s when fiber optic networks were being laid all over the continental United States. In fact, all over the globe through companies like Global Crossing, which were laying marine fiber optic networks. And by the time that decade of the 90s ended, over 90% of those fiber optic networks were dark. They were not being used. They had been built on spec, and they were not profitable because nobody was using them. That's what a bubble looks like. As we spoke about earlier, every increment of compute that is coming on in these data centers is spoken for and is profitable. Are there risks to that? Of course there are. Chinese deflation or competitive pressures from the likes of OpenAI and Anthropic, which could put downward pressure on prices and maybe profitability. But as I've said, every indication right now is that every element of compute, increment of compute that comes on is profitable. So at the moment, we don't see AI as a bubble, but of course, we're keeping our eyes open and we'll let you know if that changes. Well, on behalf of Amita and myself and all of Cerity Partners, we thank you for listening. We hope you've found this helpful, and we look forward to doing this with you again in 1 quarter's time. Thank you.